Bill Stone joins us now to talk more about this latest move to delay Britain's exit from the European Union and what could it mean for the U.S. and U.S. investors. He is the Chief Investment Officer at Avalon Investment Advisory. Bill, nice to have you with us tonight. Welcome.
Thanks.
Certainly this is still unfolding and there are many more steps that have to take place. But it seems to me that simply increases the uncertainty for global markets.
Well, I guess the good news is it does help in one aspect. It makes it less likely, because of the votes that were taken today, that Britain leaves without a deal. So, probably still leaves, but seems more likely that we end up with a deal ahead, which, all the things being equal, does make for actually less uncertainty, and we're seeing some of that reflected in the financial markets.
Alan Greenspan today said something he's said before, but he said it's only a matter of time before the U.S. sees negative interest rates like they are seeing in parts of the European Union, especially in Germany. Depending on how Brexit goes here, do you think that's inevitable, depending on how things go?
Yeah, I would disagree. I don't think it's necessarily inevitable. I view Brexit as just another, geopolitical risk sitting out there. We don't really know how bad it would get or what the, major implications would be if, in fact, they crashed out of the European Union without a deal. We just know it's probably not a good thing. And even them just sitting out there and us not knowing is bad enough, because you think about it, what corporation is going to make a big decision to, say, build a big new plant in the UK without knowing really, who they'll be able to trade with and what it'll cost and those kind of things? Those all weigh on people. It's the same thing we talk about with the kind of costs that sit there with the tariffs between the US and China.
So does that make our market more attractive relative to not only the UK, but as Italy tries to form its new government and other parts of the EU, as Bill mentioned, Germany with negative rates? Does that make the US market more attractive to you?
On some aspect, yes, because certainly, when you look at the global economy, the US, while slowing, is still looking good, really, I have to say. Probably still grow, somewhere around 2% for 2019 in terms of GDP. And yes, we're slowing into it, but the consumer still remains resilient. So corporations obviously benefit from that. All the uncertainty in Europe and the fact that Europe is much more exposed to some of the slowdown in China does make our companies, again, if you think about the more domestically oriented companies, more attractive. But that being said, obviously, there's a lot of companies even in Europe that do a lot of business in the US. So you can't completely throw out Europe.
And on that note, Bill Stone, thank you very much. Bill is with Avalon Investment and Advisory.